Well, good morning, everyone. We're talking money here from the University of Minnesota, from the campus, from the Carlson School of Management, just outside the General Mills classroom. And today, a very special panel here along CCO land and here at the Carlson School to talk a little bit about the economy, maybe global, maybe local, maybe domestic. We've got a lot of issues to talk about, especially with that jobs report coming out tomorrow. But let me introduce our panel for you here today that's going to join us. Steve Vranich is the Senior Vice President and Trust Officer of Frandsen Bank and Trust, I think a $1.5 billion company, if I'm not mistaken. And also we have Dr. Paul Vaaler. This is his home turf here. This is a home game for Paul from the Carlson School of Management. He's a professor and the John and Bruce Moody Chair in Law and Business, so double duty here at the University of Minnesota. And our good longtime friend Jill Schlesinger from CBS Television in New York and CBS Radio, where she's a business analyst. You've probably seen her on the morning news or maybe the evening news with Scott Pelley and various places. She began a pretty good experience as a commodities trader and then eventually co-owned her own investment firm. So she kind of can relate to most of us in this world of finance. And now, of course, she has a nationally syndicated radio show, a column, as I mentioned, on TV a lot. So please welcome our three panelists here this morning to the Carlson School. I mentioned at the top that tomorrow we do get a jobs report. We had a couple reports come out earlier today. But let's talk about that, how that affects us and what that's going to do for the economy nationally and locally and how concerned we should be about it. And Jill, begin the process.
So, we're going to get this jobs report out, and there's a lot of anxiety around it because the last few months we've seen job creation slow down a little bit. Last year we averaged about 260,000 new jobs every single month, and that was a great boost for the economy. This year, first quarter not so good, second quarter a little bit better, third quarter a little pullback, and I guess the expectation is somewhere around 185,000 jobs. I think the job creation is going okay. That's fine. Unemployment rate's at 5.1%. But, Paul, where's the wage increases? What's going on here? Because a lot of people are saying we usually see wages increase by about 3% a year, only about 2 or 2.2%. So when are we getting a raise, man?
Well, it's a great question to ask for. And we know a little bit, like you say, about 190,000 jobs will be coming out. And let's first off, a little bit of an applause. That's an expansion. We've had a steady expansion that's run since 2009. That's a long haul, even if it's a slower haul. You're right, though. There's still extra capacity in the economy. And it's not just that's going back to 2007 when we saw the economic floor fall out. I think what we've seen is the companies that survived that downturn have gotten much more efficient, much more flexible with the workforce. They're better at finding different ways to increase that production without necessarily having to increase employment or jacking up the wages that go with it. So they're just better at what they do. Now, let's not say it's not that it's flat. It's just that wages are going more slowly than they would be in an expansion right now.
No, but it's interesting, Steve. They're going up, but there's not a lot of inflation. So you get a regular person. Let's say I do get a 2 or a 2.5% increase, but the price of gas is down. Are you seeing that regular people are able to now contribute to their retirement accounts or save more money for their kids because they're not seeing big increases in other areas of their lives?
Well, I think the inflation rate right now is in check, but driven mainly by gas prices. Understanding that if we're saving at the gas pump, that doesn't necessarily mean the economy is going to expand. That just means we have dollars to put somewhere else in the economy. The only way the economy expands is if we have new dollars coming in to the economy, and that's by more people having jobs, making money, bringing paychecks home, or getting raises to go out and put the money in the economy. Still 70% of our economy is driven by us spending money, consumer spending. So if we're not out there spending money and buying stuff, the economy is not going to expand. Business is still somewhat cautious. They've gotten through, the Great Recession, as it were. They've restructured debt at much lower interest rates, so they're much more efficient in that regard. They're sitting on 3 times the cash that they were in 2007, so they're poised to have further expansion, give further raises to employees, but there still seems to be that final trigger that the business world is waiting for to actually make that move.
And it's interesting. I'm thinking that every economist I spoke to, and I'm going to just let you take it on the chin here for every economist, Paul, all right? They all said to me when oil plunged this is it. This is the breakthrough moment because people are going to take the money that they're saving at the pumps and they're going to go out and buy a whole bunch of stuff. And that hasn't happened. In fact, in our last personal income and savings report, the savings rate's 4.8%. So in one way, I think, wow, that's a bummer for economists. But the old certified financial planner in me says that's good for people. They're more prudent. So what needs to happen for the next leg up in the economy, Paul?
Boy, it's a great question, and I don't mind leading my chin with that. To get punched, what is it they say about economists? They've predicted 19 of the last 7 recessions. That's kind of a way of being systematically wrong. So a couple of things I think that are going on about that. A gas price decrease, oil price decrease from what was it, $120 or $100 a barrel down to $40, $50 a barrel is like a tax cut for all of us. And I'll take a tax cut whenever it comes. It's a tax cut for us as consumers and as employees. It's also an important tax cut for all the businesses that we work for. So if we haven't seen an uptick in consumer spending, which is so important to our economy, let's not forget that there's also the capital account and the investments. What we've also seen is a tremendous merger and acquisition wave, and we've also seen a substantial increase in a lot of capital expansion by firms. U.S. firms are going abroad, they're finding each other and expanding. We just need to see that turn in from an expansion that's great from the standpoint of filling up our 401ks, our shareholders, to wages and employment. That will trickle down. It's just not happening as quickly as it has happened in the past. So I'm leading with my chin, but it's a slow lead. It's going to happen.
All right. Well, I like going to happen is good. You know, I'm also wondering, Steve, that, you know, a lot of us who have been investing for a long time bought into this miracle of diversification and international investing. And everyone said, oh, it's the miracle of China and the emerging markets. And then you wake up at the end of August and you say, oh, my God, things are falling apart overseas. Are they?
Yeah.
In a word, yes.
In a word, yes. You know, to some degree, you have to put it in perspective, though. China, unfortunately, China seems to only have 2 speeds. You know, if they could, they should go out and buy a 4-speed transmission to be able to find a moderate gear in there somewhere. So it's either all or nothing with China. You know, right now, China's looking at perhaps a 6.9, 7% growth, which is double what we're experiencing in the U.S., but people are comparing that to the 16% growth they were having previous to that. And unfortunately, when China slams on the brakes, all the emerging markets, those little countries that surround China that are feeding China all these products they need for their expansion, they get walloped and said, you know, turn your ships around. We don't need this stuff anymore. So, you know, there are definitely concerns, but still there's growth in China. They're doing their own quantitative easing in China, Japan, Europe, and it seems to be working. So we see a turnaround in 2016 in the international markets. Unfortunately, it captures a lot of headlines, and anybody who opened up their third quarter 401k statement or their portfolio statement didn't like seeing negative numbers because, of course, that trickles across the ocean and affects the U.S. markets, even though things in the U.S. are good. They're very good here.
Mm-hmm. So I think Steve's point's great about that. If you're going to invest in emerging markets like China, you know, be prepared to deal with volatility. The laws of gravity work. They bring you down and they bring you up, and you have to deal with that. One of the things I like to point out about is the difference between the U.S. economy and, say, for instance, our colleagues across the pond in Europe is we're surprisingly closed economy. That is, we trade abroad, but maybe 16, 20% of GDP is derived from what we do in terms of trade around the world. We're still largely about what happens within the 4 corners of the 48 and Alaska and Hawaii. That's not the case with Western Europe, where an open economy like Germany, 70 to 80% of the GDP is about what happens outside of the boundaries for it. So I think that the China issue, it's an issue we should follow for a bunch of different reasons for it. But I think, you know, there are other economies, especially in Western Europe, that are much more open, much more concerned about this volatility. And we can be an engine of growth. I think that it would be interesting to be an engine of growth to bring China back and the Western Europe, as opposed to the way we've thought of China as this kind of source of endless demand in the 1990s and 2000s. We can reverse that.
Yeah, and you know what? I think we also have to think about where China has come from and how quickly. In the past 30 years, the Chinese economy has lifted 400 million Chinese citizens out of poverty. That's unbelievable to me, right? Just that number alone. And yeah, 10% growth for the last 3 decades is going to downshift. It's doubled in 2 decades. So we've got to actually think about that. I wonder though, you know, it is a weird system there. state-sponsored capitalism, right? So there's a bit of totalitarianism and, we want to build a city. So you 2 million people, you're moving, get out of there. So I'm wondering, as those people come out of poverty and as they create a burgeoning middle class, what about the idea of worker unrest or the demand that they're going to get more wages, how that could impact? Could that bring more manufacturing back here to the U.S.?
That's an interesting question, Jill. I'd be curious what Steve thinks about this. But my thought is, again, when I talk about China, I talk about two Chinas. There's China that's about 250 miles in from the Pacific. That China, which has experienced most of the gains you described since 1978, since Deng Xiaoping came in and liberalized so much of the economy, is essentially a middle-income country in Western Europe, and one hell of a big one. I mean, think of it as kind of Portugal, but this is, with the equivalent of the population of about the U.S. The rest of China is in a very different state. And when you see that state-run, state-directed economy, in many ways, that's there in order to ensure a minimal level of living in the rest of the 4/5 of China, which is still in a very undeveloped state. It's still, if you might say, a great opportunity, but it's much more like a less developed country. So then getting to the issue about what it is that we might tend to see in China, we'd watch closely that the large cities and that area, the prosperous 1/4 of China that's in that coastal area. And I think what you're going to see is more private business, more private expansion. I don't think we're going to see any kind of substantial change in the way the labor markets or labor unions work. That's part of the party's legacy. But I think what we want to look for is those things in the West, on the coast, versus those things inland. They're very different trends in China.
I totally agree, Paul. The economies are totally different. And that economy that's the 250 in from the sea, what we really need to try to do is get them to buy our products. The strength of the dollar obviously has put a damper on exports because our products are too expensive, to be quite honest. And so once the dollar stabilizes and comes down a bit, which it ultimately will, I think that will help that export economy as well.
I think Steve's dead on, is that we have to find ways to make that wealthy, prosperous part of China more consumer-oriented, more internationally consumer-oriented, not just producers for these goods. And there's every reason the government in China is with that. When they had this kind of abortive attempt to stimulate the economy, it was through the stock market. They were trying to get individuals to take responsibility through stock market, private investment for it. They kind of fell short with some incentives. But I think the basic idea, the basic policy is right. How do we make that fortunate fifth of China more of a consumer economy, more of an international consumer economy, and that would be great news for U.S. exporters.
So let's shift a little bit to some other parts of the world, and then we'll come back to the U.S., because I think that we get that Japan and Europe are sort of limping along. But I do want to talk about some of those emerging markets. And I'm wondering what you think, Steve, about what I call the bad children in the classroom. I always think that, the United States, it's like you're the teacher, you've got the class, right? And there's 20 kids in the class. And you know that 2 or 3 of those kids are going to be unruly. And those unruly kids can ruin the experience for everybody else. And we've got some unruly kids in our class, whether it's Russia, Ukraine, Greece, Brazil, Venezuela, Nigeria. Can any one of those problem children disrupt the global economy?
I believe they can. In the world economy, there's always the good, the bad, and the ugly that's out there. And there is some ugliness in some of those developing markets that will not be controlled. We have to understand the vast difference in cultures in some of those economies. And no matter what we say, even though we think we can impose our capitalistic ways on every economy in the world, we cannot. And so it really, kind of like your analogy, Jill, is we have to learn how to play nice and get along with some of those because they're still a vital part of the global economy.
Yeah, so I just want to add to that. Here in Minneapolis, one of the things we have in Profusion is multinational companies that are across a range of industries selling a range of products that those classic emerging markets, Brazil, Russia, India, China, all want. They all need to make big investments in healthcare. We've got the leading medical device companies in the world. They all need a more diversified nutrition system. We've got the greatest private nutrition supply system in the world in Cargill here on this. So they all need them. What we need on the business side of this for those companies and others in this area is patience. Patience and flexibility. That doesn't mean that they're going to engage in illegal activities. That's verboten altogether, but it means that the way you do business, there are varieties of capitalism in these emerging markets, in these BRIC countries and in sub-Saharan Africa. We need to train a class of executives who will go out there and be something more than just great managers. They got to be corporate diplomats. We need to train people about it. You know, the Carlson School, we train them in finance, accounting, and operations management. We should be training them in foreign languages, in international political economy and the like, because you want to deal in Russia, it's a political matter. You want to deal in Brazil, it's very likely a political matter as much as it is a business matter. We can do that. We can do better, and that's going to help buffer a lot of the volatility that goes with doing business in those fast-growing regions that also have those laws of financial gravity up and down.
And as long as you've led into it, Paul, maybe when we come back in the next half hour, we'll go into our local economy, some of the great companies we have here, maybe domestic a little bit more, but a good look at the global economy there from our three panelists here this afternoon, or this morning, I should say still, on WCCO Radio. We appreciate you listening out there in CCO land and the folks that are here at the Carlson School. That's where we're broadcasting from today. We're going to take a short break. We have some questions that the folks here have written down. We'll pop a few of those at our panelists as well when we come back. You're listening to WCCO, Minneapolis, St. Paul. Welcome back to the Carlson School here at the University of Minnesota this morning on WCCO, live broadcast with Joel Schlesinger from CBS Television and Radio, Dr. Paul Vaaler here at the University, the Carlson School of Management, and Steve Vranich, the Senior VP and Trust Officer of Frandsen Bank and Trust Company. We're talking business, economy, and we're going to talk a little bit about our local economy, too. I know Jill was tired of me this morning bragging about all the Minnesota things we had. She said, you need a Post-it note. And I said, made in Minnesota, by the way. So as I was writing it on a Cambria countertop, we got a lot of neat things around here. But we'll talk about that in a second. If I can, Jill, let's get back a little bit to Janet Yellen, if you don't mind, because everybody hears about interest rates. I'm not sure everybody knows how they affect them, but it certainly is a headline in the media. So she was on the Hill, and now what happens next with her and us?
This is a great question. This is the waiting for Godot moment in the economy, meaning that we've been at these emergency level interest rates, 0 to 0.25% since December of 2008. And the Fed was doing that because they wanted to encourage people to borrow money, spend money in the economy, try to boost growth at a time when things were falling apart. Well, here we are all these years later, and we're still at 0 to 0.25%. Beginning of the year, most people thought the Fed would raise interest rates for the first time in so many years. In fact, it's almost 10 years since they actually raised rates. And over the summer, I would say there was almost near consensus. The Fed was going to lift off, start raising rates in September, and then all of a sudden we had some problems in China and emerging markets, and there was a little freak out. Now we're thinking maybe December. The door is open back to December. So after the Fed met in the last meeting, you look at the futures markets, they said a 30% chance we get a rate increase before the end of the year. Now we're at 55% or so. It doesn't really matter. It's going to happen in December. It's going to happen in March. Rates are going up. That's great if you're a saver, and it's lousy if you're a borrower. So I guess my question for you, Steve, is that for a lot of people, that idea of a boost in interest rates freaks them out because they say, but wait, these low interest rates, this fueled stock prices, this has kept bond prices high. What will the effect of higher interest rates be on my 401k?
It's a good question. You know, I think to go back, we need to understand the difference between Ben Bernanke and Janet Yellen. Ben Bernanke, you know, they're both about inflation, but in different ways. Ben Bernanke was a scholar of the Great Depression, and every time there was a Fed meeting, he would talk about inflation, and that's how his monetary system and controls were set. Janet Yellen, in every speech that she'll make, she'll talk about the unemployment rate. She's all about employment. The more people that work, the more money that goes into the economy, therefore the potential for inflation to come up. And so we are seeing, you know, at 5.1 unemployment rate, it's great. You know, we're almost, you know, near full employment because there obviously is a percentage of the population that's unemployable. You know, as far as bonds go, interest rates, it's all about, and Jill can appreciate this as a CFP, and we're money managers, is you manage your bond portfolio. And you manage your stock portfolio through diversification. Bonds, we're staying on the shorter end of it because we know interest rates are coming up. So don't go out and buy 30-year bonds because they're going to be no good in another year or two, and you're not going to be happy with that yield that they're producing. So a rising interest rate environment, hopefully everybody's already done all their refinancing and are at much lower interest rates because that opportunity is going to be gone somewhat soon. But the rising interest rate environment will obviously bode well for investors over the long term.
Yeah, let me just add to that. Let's remember what low interest rates, zero interest rates have done for us. Our 401k went down a little bit last quarter, but remember where your 401k was in March 2009 when the Dow was at about 6,900. And then think of where it is going to be today, around 17,500 or so. We've done well if you're an investor in equities in the stock market over the past 6 years. And that doesn't show any kind of signs that that's going to go away. So yeah, if interest rates go up, we're going to have all sorts of new dynamics to deal with this, particularly in debt markets. But we've done extremely well. And what I think the idea behind that has not necessarily been that the Fed's been all about trying to endear themselves to investors on this. The Fed has a dual call to action, and it's to keep inflation in check, but it's also employment. And that distinguishes the Federal Reserve from other important national banks. The Bank of England doesn't have that. Their job is to keep inflation in check. That's it. Then the rest of it's fiscal policy. But Ben Bernanke or Janet Yellen has that dual. And the way they've done that is with low interest rates, making our equities cheaper and trying that investment. And I think they're just kind of running out of their rope. They're running out of the ammunition for that. So now they want to do something else. And I think in due course they'll get there, but it's going to be with all deliberate speed.
Yeah,
right?
and Janet Yellen said that. She said once we start raising interest rates, it's not like we're going to go to 0 to 5% in 3 minutes, right? And we know that. But it's also a sign that the economy is improving. And another sign that the U.S. economy is improving is a strengthening U.S. dollar. And we touched a little bit on that. But, you know, you've got a lot of big multinational companies here in Minnesota, whether it's 3M or Cargill or General Mills and Land Lakes. How is a stronger dollar going to impact those local companies?
So let me start with it, and then Steve, I'd be curious what you think on this as well. So I think for about 6-7 months, when we've heard less than stellar news from some of our companies here, an easy scapegoat has been, oh, it's a strong dollar. And it's harder for us because our goods are priced in dollars, and we're going into the euros dropping and our European competitors beating us, or our yen-denominated competitors beating us. I get it. At some point, that's not an excuse anymore. Because if you know this is coming, there are ways you can hedge that, and there are other things you can do. A multinational, by definition, has different operations around the world, and that means different manufacturing operations. So if you don't like things in a dollar-denominated zone, go move that production to places where the currency is, if you will, in depreciation mode and the like. We have that flexibility, and these multinationals can do it. So I think in the short to medium term, that means it's going to be a little bit harder for us to move out some of our manufactured goods. But in the longer term, as the dollar reappreciates to where it was before 2001, we're going to have to see managers and multinationals manage. And that means moving their production to where they can take advantage of these currency opportunities, these fluctuations. That's what we pay them for.
Yeah, it's interesting. I just was in Turkey a couple weeks ago, a month ago, and I met some people there from big U.S. companies who said, we're out of Abu Dhabi, we're out of Riyadh, we're going to Turkey because, why? The Turkish lira is down 25% against the dollar, and this is where we're going to plant. We're putting a tent pole here. Right, and
the plant in Turkey, in Izmir or in Istanbul, it's just as productive today as it was yesterday. It's just that because of other kind of macroeconomic issues, the Turkish lira is lower. This is an opportunity. It's an arbitrage, and multinationals can do that just like financial investors can arbitrage. It just takes a little bit more time and planning. But that's why we pay them the big bucks, and that's the kind of thing they should be doing. Don't just whine about the strong dollar.
So talking about whining, you ready? I'm going over here. Listen to this. We have a CBS News poll out recently that asked, how would you describe the United States economy? 60% of our respondents describe the United States economic conditions as bad. Now, why is it that, you know, all these years, we're almost 8 years since the official beginning of the recession. Why is it that Americans do not see the economy as good? What's going on here?
I have no idea.
Yeah, that's a good answer. Well,
because the signs are out there for a good, strong economy. You know, I think that, you know, unfortunately, Americans have short memories when it comes to markets and investments. And, you know, if they're expecting, you know, to have those 20% a year returns, or if they're remembering back to March of '09 when the stock market took off again after the Great Recession. Well, that's not normal. And what we need to appreciate is what is normal in the economy, and that is just a nice moderate growth. Signals in the U.S. economy are very good. Corporate earnings are at an all-time high. Their balance sheets are particularly strong right now. Unemployment rate of 5.1%. I mean, that's great. Government spending is still robust. There are just so many signs that indicate to us that things are good in the U.S. I think 77% of the companies reporting third quarter earnings are above estimates.
But maybe this has a lot to do with that middle class households really don't feel like they've gotten ahead over the last 20 years. So it's true, we can give them all the stats in the world, but if you say to look at somebody's life and he says to himself, I'm exactly where I was 20 years ago in terms of income, except now I got a bigger mortgage. And by the way, I got to work forever because I had to raid my 401k to get through the crisis. And, my wife lost her job or her hours were cut back, and we suffered. Is that the specter that's hanging over in this kind of a survey, you think? I think
there's something to that, Jill. I think you're getting at it. And you know who would understand this? Would be our grandparents. People who lived through the Great Depression, who watched values, real estate values, housing values, share market values plummet to near zero. And that didn't end. The risk averseness that goes with that, the anxiety, did not end in a month or a year or a quarter. That's something which took a long climb out over 8 years in the 1930s, and then a world war, and then you might have a second conflict in Korea, and an expansion after that. Get people out of it. That's not our generation. It's not even our parents' generation for it. 2007, 2008, 2009 was a bit of that, and I think there's some angst that goes with it. I think also your point makes, I think, highlights a very important distinction, which is if individuals are largely in those household based on wages and salaries, they have watched a kind of flat, if not slowly declining in real terms, trend, and that should be a source of angst for them. On the other hand, if they were investors, and so much of our middle and upper middle class income households here in Minnesota are investors, they've watched a substantial positive run since 2009 for that. So in many ways, it's getting them, I think, to think about what's happened on the capital side of the account of that household, less so on the wages and salaries, which eventually will come along the way. But if we can get them thinking about those issues, asking them whether things are certain enough is like asking farmers if prices are high enough or interest rates are low enough. But I think that's part of it. It's a psychology that will spill over to more investment going forward.
And it's interesting, Steve. I talked to a lot of millennials because I'm interested in this idea of robo-investing, where the younger generation really doesn't want to talk to an individual right now. They trust technology, not financial services. But a fascinating thing that I learned is that many millennials are really risk averse. So inside their 401ks, they've got a whole bunch of cash because they're freaked out. And yet they're willing to, go work for a startup and take a bunch of stock instead of getting a salary. But the one thing I hear about millennials is, you know what? My boss is, I got to go work at a startup because I work in a big traditional company. All of you baby boomers and Gen Xers, you're not retiring. We have a demographic problem where people are carrying debt into their retirement. They're not retiring because they can't afford to retire. But that does have a ripple effect for younger employees, right? Because they're saying, I don't see the way up through your organization. What would you tell a youngster around those issues, like the demographics? Are they going to be okay long term?
They will be okay. I think that it's definitely a different generation, and I've got some of those kids. That are my own. And so, we have those discussions, and it's that instant gratification as well, that even, my generation, our parents out of the Great Depression, it took them a long time to build what they had, and now this generation wants all of that right now. They want the 2 BMWs in the garage and the nice house, and it takes a while to get some of that. And what we're finding, too, is that which we're trying to reverse is that whole aspect of employer-employee loyalty, that the young people just don't feel there's any employer loyalty out there anymore. And we would tend to disagree with that there still is, that when we hire young people, we'd like them to retire from our company. And so we really would like to see that back. We understand that, and Jill, you and I were talking before this, if somebody offers them twice the money to go across town, there's not a whole lot you can do with that. But I think if we really show to these young people that we don't want to just give them a job, we want to give them a career, that they'll be around for a long time, that could help sway those things.
Can I pitch the other side of this too, which is you mentioned entrepreneurship, and one of the things I like to emphasize here, and it doesn't always get caught. You think of entrepreneurship and you think of startups, you say Silicon Valley or New York City or Boston, right? This is a tremendously entrepreneurial community. We have the Carlson School, I think, does a fantastic job in terms of training undergraduates and graduates to kind of think about risk-taking and small business management issues. But then just looking at the business profile here, we have more Fortune 500 companies per capita than any other state in the union other than New York, where you're from. That's got New York City. But one of the interesting things about it is we've got so many of them, but those leaders, those 20 or so that are there now in 2015, they're completely different names from 1955 and 1975 and 1995. There's a tremendous turnover on that, and that tells you this is a business headquarters, it's an entrepreneurial headquarters for business formation across a range of industries. So the opportunities for anyone who has that entrepreneurial spirit with a modicum of training are great right here.
And, I want to shift a little bit because we are at a place where there is learning going on as we speak. And I want to talk a little bit about education, because often there are questions that I get on my radio show about, hey, is it worth it for me to send my kid to a really expensive college? What should I do? How do I handle that? Steve, what's the answer as a family is planning? We know the value of a college education is huge, right? The unemployment rate for college grads is half of what it is nationally. We know that college grads tend to earn more over their careers than those who don't have that. But we also don't want people plowing through their retirement accounts to put their kids through college. What's the right balance?
I think it depends on the area of study that you're going into and what the job opportunities are out there in that area of study. If there are certain sectors of the economy that are very specialized, I think the more prestigious the degree, the better. And not only are you getting that more prestigious degree, but those schools that you're going to, for example, the Carlson School of Business, the networking that they have. My son graduated from St. Olaf, and the networking that's out there with the alums is just tremendous. As far as helping them find jobs. And so, you may not get that with a lesser school, if you will. So I think if you are going into more of a specialized area, it does make a difference, and it is a good thing to go to a better, higher school of education.
What do you think, Paul?
Well, asking an academic whether they think education's a good deal or not, I'm always going to be a proponent of that. One of the things I'd like to talk about here is at Carlson and how, especially the undergraduate experience here, we got about 2,500 undergraduates, probably go up to around 3,000. So that's a huge number, and a lot of business schools don't even have undergraduate programs. So what are we doing to provide them with the opportunity, educational and then career-wise? And I think we're doing a great job, but we can do better. We do a great job, I think, with these great undergraduates that come from the state and the region and the nationally and internationally in terms of giving them training in basic foundational analytics and accounting, finance, strategy, operations. But I still think there's work for us to do holistically. I come from a liberal arts background on this thing, and I really mean it when I say we need to train the next generation of corporate diplomats. So part of that training, if for you to be successful on an entrepreneurial business, small business, or in a large multinational, is in languages, it's in political economy, it's in sociology, it's that holistic training. And the U.S., I think, is leading in that in terms of a liberal arts education combined with the right kind of practical analytical skills for the 21st century business. We can do that. And this place, I think, does a pretty darn good job. We can do better.
And you know what? I think it's great. It's a great point because I also come from a liberal arts background. I just interviewed Fareed Zakaria from CNN, and he wrote a great book called In Defense of a Liberal Education. And a liberal education doesn't mean that, as my father says, I'm not paying all this money to send you to go basket weaving for 4 years. So it doesn't mean that. It means learning how to think critically. It means how to learn how to write. It means learning how to communicate your thoughts. And yes, part of a liberal arts education is understanding that you've got to be well-rounded. So I guess what I'm wondering is, and I'm going to play a little bit of the devil's advocate with you, Steve, why should is it really that important for me to go to a name brand school than gather those skills up? Should I gather those skills up as cheaply as possible and come out? Or should I stretch a little bit and go for more of the name? What's your opinion on that?
I think you should. Well, it depends. If you're going for an advanced degree, I think if you get an undergraduate degree at any university, you're fine. And then specialize in your graduate school. Go to the finest graduate school for that field of study that you want to be at, law, be it medicine, whatever it may be. If advanced degrees are not in your future, then I think the more of a stretch that you can do, the better, because it will pay off, again, through that networking, through that name recognition, and to be quite honest, just it's a higher quality of education that sure isn't going to hurt.
It's not bad. I know that for you, Paul, it's the hockey team.
That's
really
right.
that. So that's another factor. So I understand that.
That's right. Nothing like going to liberal arts and majoring in hockey. So that I think the big challenge for us is how we figure out how to finance college education for it. I'm going to be a little bit of, I hope, a contrarian on this, and I'm going to say we don't have enough people in college, and we don't have enough people going to all sorts of different higher education experiences for that. But what we do have an issue is how we finance that. And that's an important human capital issue for business. And for a growth area here in the Twin Cities and nationally and internationally, we have to find ways to train individuals for the 21st century to make them great corporate citizens and diplomats and citizens for this. And we can't hang over them tens of thousands or hundreds of thousands of dollars of debt that they can't get rid of in any other way. So we have to find a better way to finance this. There are different initiatives in public policy for this. There are different approaches that we can think at the state level for this. We address that issue, and we're going to be training the next generation of great flexible workers for the Twin Cities economy and for the national and global economy.
Yeah, we've got an average student loan for last year's graduates, according to Advisor, comes in at just over $35,000. That's a big number, okay? And when I went back and geeked out a little bit, I adjusted that for inflation. And I went back 20 years, and I said, let's adjust that for inflation. That is, so we always talk, college was cheap when I went there, but we're not accounting for inflation, right? But that number, that $35,000, is more than double the amount that borrowers had 2 decades ago. So, Steve, what is the danger of that debt load on these young kids? What do you see? Is it getting in the way of them buying a home? Is it getting in the way of them saving for retirement? Is it getting in the way of actually choosing a career path that might be more creative and interesting and maybe more lucrative, and just taking the job that's going to help you pay your loan off?
I think it goes back to Paul touching on the whole middle class aspect and how the middle class is feeling their financial health is. And young people coming out of that, number one, they aren't thinking about a retirement at that point in their future as far as saving for retirement in their company 401k plan. So you're really putting them behind a large debt that not only psychologically it's going to have an impact on them, but it's going to take them a long time to really get to their future, if you will, for financial health. So tell me, just
I think one of the hopeful signs of this is that I think what we've done a much better job here in the Twin Cities area, here at the Carlson School, is encouraging lifelong learning. So we talk about these great young individuals here around us in the undergraduate part, 18 to 21, 22, but we need to be thinking about how also we finance the education for people throughout their career at 42, 52, 62, because we're all working longer, because we're healthier, and because we want to be doing these things and contributing. And I think here in the Twin Cities, through a lot of partnerships with a lot of the large corporations and foundations, we're finding smart new ways to finance that. And that's exciting for me, because that means a better trained, more flexible workforce for the kind of industries that are going to be growing here and abroad going forward.
It's interesting, because being in an academic environment is always feels good for me, because I say, I want to be around people who are innovative and interesting. And I just want to end by saying that it is so great that we could be here at the Carlson School, because this is part of innovation, which is learning from one another, taking the business community, bringing it, mixing it in with the academic community, and working together to build an innovative, creative, and wonderful workforce. Hey guys, we're talking about China becoming number one. We're still number one right now, and we will continue to be the number one innovating economy in the world for a long time to come.
On a great note to end our session here today, let's hear it for Steve and Jill and Paul. From the University of Minnesota, Carlson School of Management. It's been a fun day out here. I did check, though, Jill, and she will return if we ask her. I just looked at the schedule. Tuesday, February 23rd, 7 p.m., the Islanders are playing the Wild in St. Paul. That is the next time she said she would return if we could
February,
get her back for the game.
And let me guarantee for you, Jill, it'll be 63 degrees that day, too.
Oh, perfect.
That's right. Inside, yeah. And if Oxford ever comes to town, Paul will get you tickets for that hockey team. Thank you guys very much. It was great having you here. I want to thank the audience for being here this afternoon or this morning as well. 3 minutes before noon at WCCO, and our appreciation of the University of Minnesota. Johnny, thank you for having us here today as well. Joe Jonkus, Jumpin' Joe Jonkus, was our engineer here today, and we appreciate you listening. News is coming up with CBS in 2.5 minutes.